Hello, everybody. Welcome to PENTalk, and thanks for coming today. Being as we're in November and we're almost at the end of the year, I thought that what we would talk about today is how we actually get plans in place for the end of the year. That clock is ticking, so we don't have that much time left. The year end will be here before we know it. So let's help our business owners turn a good year into a great year. That's what we're doing with qualified plans for them. So if we can help that business owner hold on to more of what they're working so hard to earn, that's usually something they would like to do, and that's exactly what the deductions of the qualified plan can do for them. It feels good to reduce your tax bill, and in addition to that, this could be a key to getting that business owner to the retirement that they would like to have by helping them accumulate money. Both good things for that business owner. So as I said, the countdown is on. December 31 is the deadline we have to be concerned with to take a deduction for this year. That qualified plan has to be established by December 31 if that business owner is on a calendar year. So that means that they have to sign their plan document by December 31. They actually have up until they file their tax return to make the contribution, but they have to have that document in place. So they kind of need to decide between now and December 31 what it is they might want to do. We have to be able to design that plan and write that plan document so it'll be in their hands to sign by December 31. So there's loads of businesses out there. Think about who you know who might be a candidate. Any business can do a qualified plan. The one that we're thinking about here are the closely held businesses. Where typically this is a conversation with the business owner who is feeling the pain of that tax bill, being successful, making money, hating what they're paying in taxes, and this usually starts with a conversation of how we can help them get that tax bill down, and it's really a conversation usually about them. Sometimes we're doing employee benefit programs because that's what they want, but usually it's focused around the business owner. So typically this business owner will be a company with less than 10 employees. They'll have earnings, they'll be profitable and paying taxes. They'll have cash flow to be able to put money into the plan. So they would like those current tax deductions and the tax savings that those bring. They may be interested in doing life insurance in the plan because they can pay for it with pre-tax premiums. So they may need some coverage, and here would be a less expensive place for them to buy it. They may be looking to save for their retirement. We can accumulate up to about $2.5 million in a defined benefit plan right now, assuming we have 10 years to get it. And the other benefit they'll get is all this money is protected from creditors if they have at least one rank and file employee in that plan with them. So, everybody hopes that bad thing isn't going to happen to them. But if it did, all the money in their business is exposed. All their personal assets are exposed. But the money that goes into a qualified plan cannot be touched. The only ones with access to that money is the IRS and your spouse. So it's a nice, safe place to put the money. Any form of business can have a qualified plan. It doesn't matter how they're set up. They could be a sole proprietor, partnership, an LLC, professional corp, sub-S, C corp. It doesn't matter. All businesses get the same plans and the same contributions. So you look at that group of clients. So who makes them a good candidate? Well, as I said, profitable. They would like that tax bill down, and they have the cash flow to be able to do this. It doesn't matter if they love the design, they don't have the cash flow. We need the cash flow to put the money in there. They probably want the tax savings. They might like the protection from creditors. If they already have a plan, that's great. They understand the advantages, but this may be an opportunity to add a second plan. For example, let's say they put in a 401k and they're making salary deferrals and they're putting their $18,000 away. But either not doing a significant profit-sharing contribution or putting in a little bit, or maybe they just want to do much greater numbers. We can layer that, for example, with some kind of defined benefit plan to give them greater contribution, or maybe just improve the design that they have to make that better. Any of those are options to talk about with that employer to help make their world a little better. So what can go right if we do this? Well, we can help business owners preserve more of what they're working so hard to build. We can help them save money for retirement, so when the time actually comes when they decide they want to retire, they'll have some money put away, and maybe a substantial amount of money put away. We could protect someone's assets from catastrophic loss, either from creditor protection or also by putting life insurance in that plan to make that plan self-completing in the event something happens to them. And it's nice business for you too. So it's good for the client, it's good for you, and it's also good for the CPA when the CPA is involved. If for no other reason that it helps that CPA kind of round out the picture for that client and get them all the tax deductions they can. So, you know, when you're approaching someone to talk about this, how do you start the conversation? Well, if there is no plan already in place, usually the conversation starts with tax savings. All those other features come into place, but usually it starts with a conversation about, would you like to pay less taxes? If there already is a plan in place, then it usually starts with, would you like to save more in taxes, maybe increase those deductions? Or how do you feel about how much money you're getting relative to what you're putting in for your employee? Maybe we can make that plan better and more favorable. Kind of a secondary conversation is we can enhance this benefit with life insurance, which either to benefit the owner primarily and exclusively, or as an added benefit for all the other employees who are participating in the plan. It's a way to build out your benefit program without picking up any additional cost for someone, let's say, who makes a profit-sharing contribution into a 401k plan. If we add insurance into that plan, now we can provide a nice benefit for those employees. Maybe we give an employee, I don't know, a $300,000 death benefit, and there's no additional cost for the employer to do that. When there is no plan, usually the biggest objection that will come up is, you know, we're talking with a business owner, you're profitable, you're paying all these taxes, yes, you'd like to pay less, let's talk about a qualified plan. No, I'm not going to contribute for my employees. I can't afford to, I don't want to, whatever the reasoning might be, but they don't want to make contributions for the employees. And I understand that, but here, when we're doing a qualified plan, if this plan is efficient, we can design it and get it efficient. If we're successful there, those employees will not cost the employer anything. And the key for that business owner to get to that step is to understand that this plan is designed around them. We're going to focus on their priorities, their issues, and their benefits. Yes, we'll have to take care of the employees. Sometimes not all of them, but certainly some of them. We have to pass all the tests. This is not illegal. We're going to do this properly. But if we get that efficient plan design, those employees are not going to cost anything because the IRS, through the tax savings, is going to pay all of their contributions. So you get that appointment called business owner. You get into that first appointment. What do you want to know on that first appointment? You want to learn about the business, you know, kind of get a feeling for what they do and who they are. Find out what they need. What does that business owner need, and what do they want? What are they looking for? Are they profitable? How much cash flow do they have to work with? You know, what kind of a budget would they want to work with here? What are their biggest concerns, and what are their most immediate concerns? And then we need a census. We need to know every employee in the company, their dates of hire, their dates of birth, and their salaries. We'll also want to know who they want to favor, and frequently they will tell us who they do not want to favor. So some common questions and objections that come up. One might be, I don't want to contribute for my employees. I already pay them enough. That's a very common one that comes up. And again, that comes to the answer. This plan will be designed around you. I understand we're not looking to necessarily give your employees a nice, generous benefit here. But let's run the numbers and see how this comes out, because if we can get this plan designed efficient for you, those employees will not cost you anything. How much will it cost to cover my employees? Let's run the numbers and let's see if we can get that cost entirely covered by the tax savings. And can the plan only cover certain employees? Well, that depends. First of all, we'll have eligibility requirements that will determine who goes into the plan. Once you're eligible, doesn't mean we have to let you in either. We can exclude some employees, not all the employees, but some. We have coverage tests we have to pass, but we have some leeway there. And lastly, for those who do get into the plan, there'll be a vesting schedule. So they can't, you know, if they quit tomorrow and walk away, they're not going to walk away with all the money. Typically, we're using a 6-year graded vesting schedule, so that employee has to stay with you a full 6 years before they're fully vested, meaning they own the money that's in their account. Here's some more. I want my employees to take some responsibility for their own savings. Great. That tells us they're looking for a 401k feature in that plan, so those employees can make salary deferrals. And here's another coverage question. I own 2 companies. Can I cover just the employees in company A and not the employees in company B? Depends. Again, we have to run the testing. We have to look at all those employees and how they're broken out between the 2 companies. Sometimes we can. Sometimes we can't. Every plan is a custom design. Every employer looks different. So, maybe. The answer is maybe. We have to get all the specifics and the look, and then we can come back with an answer to that question. All right, so let's take a look at the fact finder. So we have a 1-page fact finder for gathering this information on that appointment. There's not too much information we need, just some basic information. So we want to know employee turnover. Is it high, low, or variable? That can help us in thinking about how we design the plan and also considering how many of those employees are likely to vest. We need to know the type of entity. It makes a difference if you're a corporation or if you're unincorporated or if you're taxed that way or not. Not because of the plan you can have or the contributions, but it does affect the definition of compensation. If you are a corporation, compensation to you is what you get on your W-2. If you're a pass-through entity of some kind or taxed as a pass-through entity, then your income is what passes through as your bottom line taxable income. So that's why we need to know the answer to that question. The date the business commenced. What is your business tax year? For most companies these days, it is January 1 to December 31, but it could be different, so we have to ask that question. Does the owner have ownership in any other businesses? If the answer is yes, we need to know about that. There are rules called the control group rules and the affiliated service group rules that say if we have a business owner who either has controlling interests in more than one company or joins with somebody else in providing services to another company or to each other that are significant, that we have to bring those companies together. This comes out of rules a long time ago that the IRS came out with in response to employers who figured out if they put themselves in one company and all their employees in another company, they could cover just themselves by having a plan just for company A. The IRS said, no, you can't do that. Those companies get pulled together. So that's why we have to ask those questions. Do you currently have a qualified plan? Yes or no? No is the simple answer, but if the answer is yes, we want to know what kind of plan they have, and then ultimately we'll want to know what they're doing with that plan, what kind of contributions they're making to that plan relative to what they would like to be able to do. And that brings us to our desired contribution amount. How much do they want to put in? How much can they afford to put in? If we don't have a number here, and frequently we're asked to run proposals showing the maximum contribution, which is fine, but if we come back and say, here's your maximum contribution is $250,000, and then they go, but I only have 50, I can't afford 250, then we kind of wasted some time because we'll have to go back and start from scratch again. So if you can get, the more accurate a contribution amount you can get, the more helpful it is to everybody, and the more it will speed up the process. These questions are about trying to get at the business owner's objection, not objection, their objective, and some factors that will affect the plan design. Is their income variable or is it consistent? If it's variable, we don't want to put them into a plan that's probably going to have a substantial, obligation to contribute. We want to give them the flexibility to flex that with their income. Again, the same thing, would you like to have flexibility or are you comfortable making fixed? All that's getting to that same question. Are you seeking contributions of $500,000 or less or $500,000 or more? That's going to tell us in a defined contribution plan, so that would be profit sharing and 401k, we're limited this year to $54,000 for somebody. If they have the catch up on top of that, we can get them to $60,000, but we can't get any higher than that. But if they're looking for a bigger contribution than that, a bigger deduction, we can go into a defined benefit plan where those numbers can go substantially higher. They could go into $200,000 or $300,000. We don't have a dollar limit there. So answering that question will kind of steer us down the path of where we want to be. If they're staying under $50,000, we'll usually stay in a profit sharing or 401k to keep their life simpler. But certainly if we want to go over that number, we're going to start looking at defined benefits. And then, of course, the last question, do you want the employees to make contributions? We're looking to see if they're looking for a 401k component there. Who does the employer want to favor? This is important. We need to know who we're trying to favor. Now, it'll almost always be the business owner, but then sometimes after that, they surprise us. Sometimes there's a key employee they want to favor. Sometimes there's a key employee they particularly want to go out of their way not to favor. I certainly have had that happen. Sometimes there are family members in the plan that they also want to favor, and I've had employers with family members in the plan that they did not want to favor. So we want to ask this question, just tell us, who do you want to favor? We'll take that information, and to the best of our ability, within what's allowed by the law, we will design a plan to do just that. And then that brings us to the census. So we need full census data on all the employees. Their name, if they don't want to disclose their name, they could just give us their first name, or they could give them a number, as long as we have some differentiator so we can identify them. Job titles are important because sometimes we want to segregate our employees into groups. For the plan designer, we would do that by job title. We need to know who has ownership in the company and to what degree, and then we need dates of birth, dates of hire, and income for everybody. If there are part-time employees, we need to know how many hours they work. The key for qualified plan purposes is 1,000 hours. Do you work more or less than 1,000 hours during the year? So we want to know how many hours. Now, for the income definition, as I said earlier, anybody who's a corporation, we have to use the W-2. So if they're a sub-S owner and we ask what their income is and they say it's $250,000, we have to ask a second question, how much of that is on your W-2? Because if they tell us $250,000, but it turns out their W-2 is $55,000 and the rest is all pass-through, it's going to change the plan contribution in the plan numbers quite a bit. So we're only allowed to recognize W-2 for any corporation, so we have to ask that question. If they're a professional corporation, we need to ask, are they taxed as a pass-through or a corporation? If it's a corporation, that takes us back to W-2. If it's a pass-through, then we get to use the net pass-through income. Same thing for sole proprietors, it's their net Schedule C. Partnerships, it's their net K-1. So we need those numbers, though. We cannot do anything on a proposal without dates of hire, dates of birth, and income, because that's going to drive the numbers. So once you have that information, it's 2 sides of 1 page, the fact finder. You can send that to me at mary.reed@pentegra.com. We'll get proposals run. For those of you working with National Life, we work very, very closely with National Life. We work with Qualified Plan Marketing there. Sometimes we have them run the proposals. Sometimes we run the proposals. It all depends on what plan type we're running and whether we're running it with and without insurance, those kinds of factors. But we'll coordinate all that, and we'll get that proposal back to you. I'll be honest, typically we get them back within 2 or 3 days, but we ask you to please allow a week. Don't make that follow-up appointment for at least a week out to allow enough time for us to get the proposal to you and to also go over it with you and answer any questions you might have before you take it to your client. So here's what the proposal will sort of look like. Here are a couple of pages from the proposal. There are more pages in this, but these are the pages that the employer really usually cares about. The first is who's getting what. So here you see the plan contributions. And you can see here we have Dr. Pat and Dr. Chris who own this business, and then 3 employees. You can see the contribution that's being made for each of them, $189,000 for Pat and $153,000 for Chris, and then you see the employees. You see the total at the bottom of $372,612. $346,000 is being contributed for our doctors. So 93% of the contribution here is for the doctors. So they probably like that. They probably think that's pretty good. But then we go to the next page, which is, well, what does this really cost them? And this is where we get into what do those employees really cost. So here we have a total plan contribution of $372,612. That is all deductible on a tax return at a 34% tax bracket. That's a tax savings of $123,388. So their net out-of-pocket cost to actually do this plan is $249,224. The IRS is kicking in that $123,338 because that's coming back in tax savings. So if the net after-tax cost is $249,224, but the contribution for our 2 doctors is $346,419, they have a net gain by doing this plan of $97,195. So, did we contribute for those 3 employees? Yes, we did. The amount we contributed for them was the difference between $123,000 of tax savings and the $97,000 of that that's going to our 2 doctors. The difference is what went to the employees. But did that come out of the doctor's pocket? No. It came out of the IRS tax savings. So what is that, about $25,000, give or take, that we're giving to those employees, fully paid by the tax savings. Now, this page is key to the case, so the doctors wanting to do the case. They have to understand here. And they don't understand this unless you explain it to them, probably. If they decide not to do this plan, which is what they're doing right now, saying no and not doing this plan is costing them $123,388. They're paying that money in taxes. They're profitable. They're paying it in taxes. So saying no here costs $123,388. Saying yes puts the 2 doctors ahead $97,195. That's money that's come back from the IRS to be invested for them. Yes, we're contributing for those 3 employees, but what difference does it make? Frankly, that's all being covered by the tax savings and the rest is going into the owner's pocket. Why would you not do this plan when you could come out ahead $97,000 as opposed to paying $123,000 in taxes? Business owners won't necessarily understand that when you start the presentation, but they should understand it by the end. If you don't show them this page, what they'll think the plan costs is the plan contribution of $372,000. That's not true. You have to take into account the tax savings, which are probably driving doing this plan to begin with. All right, so let's say that they want to do that. How do you implement the plan? So we want to close the plan. So you present the proposal, and hopefully they're happy with the proposal. That sometimes we do a couple iterations on the proposal to get it where we want. Once we've got that proposal the way they want, they're ready to move ahead. They say yes. We have to establish that plan. Remember, we have to get their plan document written so they can sign it by December 31. So PENTalk uses an installation workbook for that. We will send that to you with the proposals. We can help you fill that workbook out if you want our help. That workbook comes back to PENTalk with a fee for the installation. That fee varies depending on what kind of plan it is. We will have sent you the fee schedule as well. So that comes back to PENTalk, and the workbook can come back electronically. The check has to come in the mail. And then we will write the plan document for them that reflects that proposal. We'll probably have a document call with you and the client during that process to make sure we have everything just like you want it. We'll then generate the plan document. We send those back to the client. The client signs the signature pages. Now they've met that legal requirement by December 31. They return those signature pages to us. We will get a tax ID number now for that plan because that plan creates its own trust. And once we get that tax ID number, then money can go into that plan, can be invested in whatever the investments are going to be. If you're doing life insurance, the applications can be submitted, and PENTalk will do the ongoing administration of that plan. So what does that mean? PENTalk will do the administration, so that means we're going to keep that plan in compliance. We're going to do all the testing, the reporting. We're going to file the 5500 for that plan. PENTalk will provide all those services. That's what we're here for. We'll help coordinate with you with the products that are in there, if there's insurance and servicing that, because we'll be reporting on it, and we can help you with that. And of course, we're always here to provide technical backup if questions come up. We have all the experts here. We have the ERISA attorneys and the actuaries. So should a question come up, we can always answer it. You know, our goal here is we're going to do everything we have to keep that plan in compliance and keep everything operating smoothly for that employer. Again, just a reminder, those documents have to be signed by December 31. So that December 31 is the key signature date, but the other date you have to be aware of is December 12th. PENTalk needs time to get that document written to get it back to that client so they can sign it by December 31. So our deadline is actually December 12th. We need that installation booklet and installation fee into us by December 12th to give us time to get that document written and make sure we have it into that business owner's hands by December 31. So with that, that was kind of just a quick run through of just get you focused on what you need for year end. Of course, you can always call You can always email with any questions. We'll help you through that process. My phone number is up there on the screen, 802-477-2018. We're always happy to help you. Our goal is the same as yours. We want to help you get that client in a good position and help you get them a better year end. So please take advantage of our services. We're more than happy. We're always here to help you. And thanks for tuning in today.